Hey there, everybody. It is Colby, the DGI Crab, coming to you on a Tuesday. I had some content planned for today, but then, sometimes the stock market does some wild things, and you've got to just shift focus and cover what is in the news. And major events sometimes happen, and we've got a big one here today. Genuine Parts Company, stock ticker GPC stock, is down about 18% today. They missed earnings pretty bad, pretty bad. And the Dividend King, 67 years of increasing their dividend, including this year, they did so earlier this year already, is just absolutely cratering today. So I thought that I would hop right on here and go through a little bit of the news, see what the heck's going on, and try to see if this is a stock that we ought to be taking a look at buying right now. I don't take anything I'm going to tell you here as financial advice. I'm doing my due diligence right now on this stock. You should do yours as well. I am not a professional investment advisor, so don't do anything because I told you to do it or because I told you not to do it. We're going to just learn about this one together and see just what the heck is going on with GPC. Like I said, it is a dividend king with 67 years of increasing the dividend. It is one of the 60 stocks that this channel focuses on. It is in my tier 3 category for the 42 to 53-year-old investor. I haven't updated the valuation metric here. I usually rank these in order of most undervalued to least. And you can see here since last Friday, Genuine Parts Company has now jumped into my buy zone, which is 30%, yielding 30% or more above the 4-year average yield. 4-year average yield of 2.56% right now with the stock price dropping. It's yielding 3.43% or nearly 34% higher than the 4-year average. So we'll have to wait and see what happens, like with the payout ratio and all of that business. But man, what in the world is happening here with GPC? So if we go here, we've got a couple articles pulled up, one on Yahoo Finance. We can see what's happening here. So what we've got here is they've got sales up 2.5% on the year. Its non-GAAP profit of 188 per share was 22.5% below analyst consensus estimates. So their revenue, 5.97 billion, was in line with analyst estimates of 5.95 billion. The adjusted EPS was the one that really missed, $1.88 versus expectations of 243. And they beat on the EBITDA 582.1 million versus estimates of 563.7. So that was a 3% beat. Management lowered its full year adjusted EPS guidance to $8.10 at the midpoint, a 13.8% decrease. So the stock's down 18%. Management adjusted EPS guidance down 13%. So maybe we have a slight overreaction, perhaps. Free cash flow margin is down 6%. Not good news there. Let's see. They've increased their locations to 10,700 at quarter end, which is up from 10,000 last year. So more locations. Same store sales are flat. Slight miss. And let's see here. If there's anything else interesting in this one. Okay, I'm going to flip over here to Bazinga, see if there's anything on this site. It can give us any additional information. Let's see, 2.5% year over year. The company attributed sales growth to a 3.2% benefit across acquisitions, partially offset by a 0.8% decrease in comparable sales. Sales grew 4.8% year over year. Let's see. And I'm just discovering this all at the same time here with you guys. Like I said, I just wanted to hop on here and go through some stuff and see what we could figure out here together. Cash equivalents totaled 1.08 billion as of September 30th. Net cash generated from operating activities for the first 9 months was 1.1 billion. Genuine Parts fiscal 2024 revenue growth outlook to 1%, 23 to 23 billion. let's see, adjusted 2024 EPS outlook to $8 to $8.20. Prior was $9.30 to $9.50. Consensus $9.36. The company still expects fiscal 2024 free cash flow of $800 million to $1 billion and operating cash flow of $1.3 billion to $1.5 billion. Wow. I mean, definitely not great news. Let's look over here at Seeking Alpha and just take a quick look at our dividends here. So annual payout of $4 per share. Payout ratios are sitting at 41% right now, which is perfectly fine. Would indicate it's a safe dividend, but we'll have to pay very close attention to this over the next few days and see if the payout ratio gets affected by these numbers. They do have that 67-year history of increasing the dividend. So it's not like this is the first time that GPC has reported a bad quarter over the past 67 years, and they've continued to increase their dividends throughout all of those many decades. Gross profit margin, and maybe Seeking Alpha. We may have to come back here again on Friday when I do the purchase video and see if any of these numbers get updated between now and then. Seeking Alpha could be running behind on some of this stuff, but gross profit margin of 36%, sector median is 37.5%. Free cash flow margin, cash from operations of the trailing 12 months. So, I mean, there's a lot of really positive things here. They're better than the sector median on the vast majority of these profitability metrics. So listen, when you purchase stocks as a dividend growth stock investor, when you're adding new money into the accounts, generally speaking, you are adding stuff when bad news occurs. Because what we're trying to do here is we're trying to add dividends from blue chip stocks that have a long history, like Genuine Parts here of 67 years, a long track record, a long history of increasing their dividends. So if you're wanting to get good companies at bargain basement prices, when do bargain basement prices occur? They occur when bad headlines hit, when there's a bad financial quarter. If there's some bad news in the just floating around out there about the company, and there's negative headlines, and people all start just jumping out of the stock, selling it off, taking profits, or whatever the case may be, because they're worried about the short-term implications of the bad news. Now, I'm not telling you to run out there this morning and just load the boat on GPC, but this is definitely something I'm going to be keeping a very close eye on. This is one of the largest price drops that I have seen among these 60 high-quality dividend growth stocks really since Nike crashed by 21% a few months ago. Now, Nike has recovered a little bit since then, but not fully. So this is probably one where over the course of the rest of this week, you're going to want this on your watch list. You're going to want to see if this one is going to continue to drop even further, or if it's going to sort of level out and eventually recover. I have no idea which way the stock's going to go at this point. No one does. If anyone out there tells you they know exactly where it's going to go from here, they're lying to you. So all we can do is trust the metrics and trust the history that the company has. So pay very close attention to this one. I'll have some updates for you on Friday when I'm doing the stock purchase video. Right now, GPC looks like it is in the buy zone for the tier 3, 42 to 43-year-old investors. It's hit that green 30% or more above the 4-year average. Again, that doesn't necessarily mean that this morning is the time to run out and buy. We may want to wait for the dust to settle a little bit and just see what happens. But as I mentioned before, they have a 67-year history of increasing their dividend year over year. And I really don't think that this is the first time they've had a bad quarter and saw their stock price just absolutely crater. This has happened to them before. And they have managed to get through it and continue to recover, continue to increase the price of the stock, and more importantly, increase those dividends consistently. So I don't have any predictions here for you. I'm not a prediction guy, because prediction guys, I don't think have any idea what they're really talking about. It's all just projection and playing around with numbers. And the numbers that I'm concerned with are the history and the 4-year average yield and what it's yielding today. So this might be a really ideal buying opportunity for a Dividend King with one of the longest active streaks of increasing dividends year over year for their shareholders. But I usually don't dive right on a company when it crashes. I did with Nike when it did, but even as I saw with Nike, I started loading up the boat at like $76 a share, and it still had further to go. It ended up dropping all the way down to $71 at its lowest point. So maybe GPC still has a little ways to fall. If you want to try to time that, that might not be a terrible idea, but keep a very, very close eye on this. Like I said, I didn't have anything really prepared for this today. I'm learning about this right along here with you guys. I'd like to know what you think, what you're seeing in your research as well. Are you running out there and buying GPC right now? Or is there something in the metrics? Is there something they reported that's really scaring you off to where you don't want to touch it with a 10-foot pole? Let me know one way or the other in the comments below. I'd love to know what you think out there in the DGI community. So hey, my name's Colby, DGI Crab. Email me questions at dgicrab@yahoo.com. I'll catch you on the next one.